Today, we are taking a deep dive into an iGaming market that is both really promising and honestly pretty perplexing, Burkina Faso.
Yes.
On paper, this market looks like gold. You got high population growth, one of the youngest populations on the planet. It just screams future digital consumer base.
Exactly. But the reality on the ground is so much more complicated. And that's what we do. We are the Gambling Databases Research Team, a group dedicated to delivering in-depth analyses of the global iGaming landscape.
Right.
In each country-specific report, we explore key aspects like local regulations, taxation, player experience, operator conditions, and emerging trends. Our goal is to provide a clear, data-driven understanding of how the gambling industry functions within each market and, what makes it unique.
And the mission for this deep dive is really to get to the heart of the paradox in Burkina Faso. We're looking at a market with an almost unbelievably favorable tax environment, a huge green flag that gets completely wiped out by financial unit economics so crushing they make profitability, almost impossible.
It's a real tightrope walk.
So let's start there. Let's lay out the regulatory groundwork.
Okay.
If you just look at the structure, the government seems to have its house in order for traditional betting.
For land-based.
Land-based gambling, so casinos, sports betting shops, lotteries, it's all legally regulated by the Commission Nationale des Jeux de Hasard, the CNJH. That part is clear.
What's fascinating here is that the second you move into the digital world, all that clarity just, poof, evaporates.
Gone.
Online gambling is in a complete regulatory gray zone. It's not explicitly legalized, but it's not officially banned either.
And for an operator, what does that actually mean?
It means critical risk. The government basically reserves the right to just block unlicensed online platforms anytime it wants. Your entire operation could be shut down tomorrow. No recourse.
Wow. That makes the decision to even apply for a license.
Wow.
You can't, right? You said there's no formal online licensing framework as of 2025.
Not for online, no. You can only look at the land-based rules for guidance.
And for land-based, the fees are somewhere between $30,000 and $50,000 with a 4 to 6 month processing time. It's an investment, but an operator going in today knows they're flying without that safety net.
And you can't just do it remotely. Our source data confirms this. If you're a foreign company, you have to establish a local legal entity.
A mandatory local presence.
Right, which adds a ton of operational complexity and cost, even before you factor in the regulatory risk. You have all these fixed costs in the country, but your revenue stream could vanish overnight.
Okay, but let's talk about the headline number, the thing that makes everyone's ears perk up.
The tax rate.
The tax rate. The biggest twist here is the taxation. Operators get a unified 5% GGR tax. Gross gaming revenue, 5%. That is genuinely among the lowest GGR rates anywhere in the world. If you're a big international operator, that number is screaming opportunity.
It is an exceptional green flag, but we have to look deeper at the true tax burden. On top of that 5%, operators also have to pay the standard corporate income tax, which is a pretty hefty 27.5%. And crucially, players are not taxed on their winnings.
So the entire tax burden falls on the operator.
The whole thing. It means your effective tax rate on profits is actually closer to 32.5%, even with that low GGR number.
Wait, I have to stop you there. Even at 32.5% effective. That's pretty normal, isn't it? I mean, compared to somewhere like Germany or the UK, where GGR taxes alone can hit 20 or 30%.
That's a fair point.
In fact, the lower GGR tax should actually offset a lot of the risks, shouldn't it? It gives operators more margin to spend on marketing or tech.
It absolutely should, and it would. Except for the second, much more brutal half of this equation. The low tax rate becomes completely irrelevant when you realize the unit economics of the player base are, well, they're fundamentally broken.
Okay, let's unpack this. This is the reality check.
Yeah.
This is where we go from regulatory optimism to economic despair.
Pretty much.
We're dealing with a population of about 22 million, which sounds decent. But the buying power is incredibly small. The GDP per capita is only $950. Just to give you some context, that's hundreds less than similar markets like Ghana or Ivory Coast.
And the demographics just hammer that point home. The median age is a staggering 17.2 years old.
17?
17. You're basically looking at a market of children and teenagers, not financially stable adults. And when you combine those two things, ultra-low GDP and an ultra-young population, you realize The market size is just microscopic.
How microscopic are we talking?
Our estimate for the total market size, and this is everything, land-based casinos, sports betting, lottery, is only about 65 million US dollars for 2025.
For the whole country?
For the whole country. The online part of that is tiny. We estimate it maxes out at somewhere between $15 and $25 million a year. That's not just small. Globally, that's a niche. If an operator is looking for any kind of serious scale, they will not find it here.
And this is the critical part. Let's get into the math that makes that 5% tax rate meaningless. Average revenue per user ARPU versus customer acquisition costs sit. Because the GDP is so low, the ARPU, so what you can expect a customer to spend in a whole year, is estimated at just 30 to 40 US dollars.
$30 to $40. But then, because of the competition, the gray market risks, and just how hard it is to reach that small urban minority, the estimated cost to acquire a single customer is somewhere between $80 and $150.
Wait. You were telling me an operator has to spend anywhere from 2 to 5 times the revenue that customer will generate in their first year just to get them in the door?
Precisely. And here's where it gets really interesting. When you look at that CAC to ARPU ratio, it is fundamentally unsustainable.
It's upside down.
Completely. In a healthy market, you want your CAC to be less than your first-year ARPU. You want to break even quickly. Here you are starting deep in the red.
So how long does it take to break even?
Minimum, 48 to 60 plus months. That's 4 to 5 years, best case. To sustain that kind of burn rate, an operator needs to be prepared to just light a couple $1 million on fire. You'd need at least $2 million just to cover your losses in marketing for 5 years, all while chasing that tiny $25 million market.
So effectively, that 5% GGR tax saves you a few pennies on the dollar, but the cost of attracting that dollar is quadrupled. The players just don't have the money to make it up.
The financial structure of the consumer base is the core problem. It's not the regulations.
Wow.
And that young demographic we mentioned, with 42% of the population under 15, that brings another massive challenge.
Responsible gambling?
It's a huge responsible gambling and reputational risk. Age verification is incredibly difficult in a developing market that relies on informal digital infrastructure. If you can't effectively prove you're blocking minors, you face enormous long-term brand damage. That's a cost far greater than a $150 CAC.
Okay, so even if an operator decided to swallow that 5-year break-even and all the demographic risks, they still have to actually reach the customers.
Right.
So let's pivot to the tech side. You'd think a younger demographic means a really strong mobile environment.
And in the cities, you'd be right. Mobile penetration is strong, over 85%. And smartphone adoption in the main urban centers is also over 85%. It really is a mobile-first environment for anyone who's connected.
But this raises an important question. How few people are actually connected?
That's the catch. Nationwide internet penetration is only 30%. And on top of that, average speeds are really low, maybe 5 to 12 millibits.
So what does that mean in practice?
It means the addressable audience for any iGaming operator is heavily restricted to that urban minority. Trying to scale outside of, say, Ouagadougou or Bobo Dioulasso is functionally impossible. It just caps your potential revenue stream even further.
And getting money from that small digital market depends almost entirely on one thing.
Mobile money.
Mobile money services. Orange Money, Move Money, Wave. These are absolutely critical for deposits and withdrawals, right?
They're everything. And this reliance creates a monumental operational risk. Banking penetration is under 25%.
So 3/4 of the population is unbanked.
Exactly. So if the government, or even just the two main mobile operators, the telcos, decide to restrict gambling transactions, they could cripple an operator instantly.
Instantly.
There is no banking fallback for 75% of the population. This vulnerability is maybe the highest non-financial operational risk in the entire market.
Given that, it makes sense why the popular activities are what they are. Sports betting is number one, followed by lotteries, and engagement just peaks during big international sporting events.
And we have to stress, this microscopic market isn't empty. It's already served by big international brands like Betway and LeoVegas, plus local operators.
So even for that tiny pool of customers, you're fighting established competition.
Which just makes your acquisition costs even higher.
So when we see operators like Betway and LeoVegas already there, does that mean they found a secret model that works? Or are they just playing the exact 5-year loss leader game you described?
Based on the underlying economic data, it is overwhelmingly the latter. They are not chasing profit in Burkina Faso today.
They're chasing footprint.
They're chasing regional footprint and locking down market share, hoping that those key metrics, GDP, internet penetration, start to improve dramatically in, say, 5 or 7 years, they're banking on the future, not the present.
So if we summarize our whole deep dive here, the story of Burkina Faso is really a perfect storm of unsustainable economics.
It is.
You have this incredibly attractive 5% GGR tax rate, which is a huge green light for your margins. But it's completely canceled out by the crushing combination of low GDP, low ARPU, and just prohibitively high CAC.
So our final verdict, based on this synthesis, designates Burkina Faso as an emerging frontier market. It gets an overall attractiveness rating of 5.1 out of 10.
5.1.
Our analysis confirms this market is suitable only for patient, exceptionally well-capitalized Pan-African operators who can stomach a negative cash flow for 5 to 7 years. It's designed to be a strategic loss leader for regional presence, not a profit center.
It's the ultimate slow burn bet on an entire nation's economic potential.
It is. And this raises an important final question to leave you with. Given that 42% of the population is under 15 years old, is the true strategic value of this market entirely based on a massive 10-year gamble? A gamble that the GDP per capita and the national internet infrastructure will multiply, making all this initial high cost and risk worth the long-shot demographic payout?
That is a tough question for any investor trying to balance present risk with future possibility. Thank you for synthesizing all that critical data and making that core contradiction so clear for us today.
You're welcome. And for the full text of this and other country reports, you can visit our website at gamblingdatabases.com.